going on, guys? Wanted to touch base, get a market update out to you for June. I know it is July 5th today as I'm recording this, a little bit past the June deadline, but wanted to, again, just get that monthly update out to you, talk to you a little bit about behaviors, how your behaviors and future actions going forward can potentially have a pretty large impact on the returns of your portfolios with everything that's going on in the volatility. And again, really just talk a lot about the behavior side of things today. But just to get started here, I want to look at the major indexes. Again, I have the time frame set to June 30th, so this isn't current as of July 5th when I'm recording, but up to last month, year to date, where was everything at? Looking at the Dow Jones, it was down a little over 15% year to date at that point in time. The S&P 500 down a little over 20%, and then the NASDAQ, the tech-heavy index, again, that we've been talking is getting really beat up with Fed tapering, with inflation, all those sorts of things, down almost 30% there year to date. So the numbers still not looking very good. It's been a very rough first half of 2022. So I want to look at everything from a historical perspective, shed some light on what's going on, what could happen in the future, and again, how behavior kind of plays into all of this and wraps into everything that we're going to be doing. So I want to start by just telling a little bit of a story that happened this morning. So for the 4th of July, actually went up to a little town called Taylorsville, California. Some of you might be familiar with it, and some of you watching might have been there with me. But it's a small town, about an hour and a half outside of Lake Oroville. Really, really beautiful area up in the mountains. They have an awesome roping up there. You just get to rope, camp out with buddies. It's really a great time. So spent the 4th of July up there. Now back in the office and back to business here. So this morning I was going through all my emails and my voicemails and everything, just getting caught up, on everything that I missed over the 4th. And I had a voicemail from somebody, and I get a ton of sales voicemails. I'm sure, most day and age, everybody gets these voicemails, but I get a ton of salesmen for mutual fund companies, insurance companies. The huge one, I get this all the time, are the lead generation programs where, hey, buy my product and we'll provide you 20 leads a month, whatever. I get at least one voicemail a week, and I get a message every single day, without a doubt, every day on LinkedIn from some new lead generation company. So anyways, I'm listening to my voicemails this morning, and I had one from one of these lead generation firms. And I'm not kidding you. This is not an exaggeration. I'm going to do my recreation of how the voicemail went. So the person says just this exactly. Hey, Hunter, this is Joe Smith from XYZ Lead Generation Program. I'm calling you today to talk about, anyways, I'm just wanted to touch base so that we could talk about how our proprietary system can offer you more leads going on in the future. I was just baffled. The guy legitimately flat out yawned. I couldn't even do it for real. He yawned for 10 seconds, maybe, not exaggerating, on the voicemail, and just had zero enthusiasm. It was disgusting, the voicemail that the person left me. How he thought that I was going to be excited about that product and want to call back and learn more. It's baffling to me. But just thinking about it, and from the behavioral side of things, that person is a salesman. They obviously probably have a sales goal, if not a sales quota, that they're supposed to be hitting. How in the world, by having that sort of level of enthusiasm and that type of behavior, do they ever expect to reach any of their goals that they have set for themselves? There's just no chance. And, a lot of my job is helping my clients to reach the financial goals that they have set for themselves. So if they come on with that same level of attitude and that same lack of enthusiasm, then it doesn't matter how good the products that we have set are, how good the investments are. It doesn't matter how good of simulations we run. None of that stuff matters if you have zero conviction or zero enthusiasm for what you're trying to accomplish. So again, it's just kind of funny, kind of played in with the behavioral side of things, but it was by far the worst voicemail, the worst sales voicemail I've ever received in my entire life. So moving on from that and talking a little bit more about the markets and about yourself, I want to talk about the question of, should you be running from the bear market? And I know this has kind of been a continuous conversation, but it's just kind of the main headline still. And I don't think that's going to change anytime soon. So when there's craziness happening and volatility happening, there's nothing else that we can look back on besides historical trends. we don't know what's going to happen in the future. I mean, I have a good idea of what is going to happen over the long run, but over the short run here, we don't know what's going to happen. So we can look back on history, see what's happened in the past, and that can help to temper down on emotional feelings that we may be having and help us make the correct actions so that we're not making quick decisions that might hurt our portfolio. So I want to take a look at a couple pieces here, and again, just put things into context. I need to move my face out of the way a little bit. So this piece here, basically, since 1929, there have been 15 bear markets during that time frame. The average bear market out of those 15 has lasted about 19 months, so about a year and a half, and it's had an average decline of 38%. So these are all of the different bear markets that we've been in. This is ours in 2022. I'm going to scroll down a little bit so you can see it just shows the number of days that they've lasted. Kind of crazy, actually, on here. The shortest one being 2020 was that really quick COVID crash that happened. I mean, that was one of the weirdest bear markets and downturns that we've seen. So normally they last about a year and a half, and they drop around 38%. So right now, the bear market we're in has been 6 months time frame, and it's dropped about 22%, 20 to 22%. So all of that being said, historically, what could we expect to happen? Well, if we're just looking at the averages here, we could expect that this bear market is going to last roughly a year longer, and we have another downside of roughly 18% on a historical average basis. So then the question comes, okay, Hunter, duh, why don't we just sit in cash for 1 year, wait until it drops 18%, then buy back in? That's the bottom. Yeah, I know, I wish. I wish it was that simple, right? We'd all be millionaires. But the first most obvious rebuttal is that's just historical, right? We don't know if things could recover much quicker, and we really do not want to be in cash and miss out on any of the updates. And here's why. I'm going to show you this on the next slide here. So let me scroll down a little bit, get everything set up. The power of staying invested. So the reason why I do not believe in playing this timing game, and I talk about time in the market, not timing the market. We cannot time these events. We don't know what's going to happen in the short run in terms of actually sitting in 100% cash and then rebuying back in. This is what has happened historically. This is from 1990 to 2021. So over the last 31 years, this is what the averages have done. If you were fully invested over the last 31 years, you got about an average annual return of 10%. Now, that doesn't mean you're getting 10% every year. Maybe some years you're getting 20%, some years -5%. But the market did about 10% over that 31-year period. If you missed out on the single best trading day, one day, you missed out on the single best day out of 31 years, you dropped from about 10% down to 6.2% for missing one day in 31 years. Over that time frame, if you missed the best 2 trading days, you dropped from 10% down to 3.1%. If you missed the best 3 days, you're at an average annual return of 0.5%. You missed the best 5 days, you're at -4%. You missed the best 10 days, average annual return of -12%. If you missed the best 20 days, you're down 24% on an average annual basis. So that is the main reason why I don't believe in sitting in 100% cash, because we can't afford to miss the single best day, let alone miss the best 2, let alone miss the best 10. So if you're going to sit in cash, you would have to have enough of an opinion and enough conviction behind your thought process to tell me that, okay, Hunter, the amount of time that I'm going to be sitting in cash, I can guarantee that I am not going to miss the single best trading day out of a 31-year period. I will not miss that one day while I'm sitting in cash. I don't want to take that bet. I mean, that's just crazy to miss a single day, and it changes that drastically. Now, the other crazy part of this equation, and the last thing that I want to show you guys here, is when we're actually looking at what inflation is. Inflation is normally around 2.5% on an annual basis. So during that time frame, again, over 31 years, you're in cash during the best 2 trading days. You're only getting that 3.1%. You're hardly outpacing inflation at that point. When if you're just stayed fully invested that whole time, we would have been absolutely crushing inflation. It wouldn't have even been an issue. So all of that being said, just to say, every single time, people have always, over the long term, been rewarded for being patient. They always have. And, if they don't, something crazier is happening, then we don't need to be worrying about your money at that point. The entirety of US capitalism is just coming down upon us. So that'd be a whole different conversation. But people have always been rewarded for being patient. Your losses that you currently see are not real losses. They're only on paper. Those losses only become real when you go hit the sell button and you lock those in. You're only going to get hurt when you actually sell your positions. You still own the same amount of shares, so they still have the potential to bounce back and to reattain those prices that they were at previously. So again, I do not believe in timing any of these things. I do not believe in running from the bear, but that doesn't mean that we're not rebalancing portfolios. That doesn't mean that we're not changing our investments to take advantage of different sectors that may be undervalued at the time. That doesn't mean that we're not paying attention and maybe sitting in a little bit more cash than normal. Again, a lot of people are in around 10 to 15% within our models, not 100. Normally, we're only in 2 to 4% just to have some opportunistic cash on the side. But getting out of the market, panicking, being afraid, letting your emotions overrun yourself, that is a recipe for disaster, and that's how people get really, really hurt. So again, I just wanted to put everything into a historical context. Oh, sorry. I got one more slide for you. This is the average rate of return that the market has gotten once it fell 20% from its previous peak. So 20% from its previous peak, that's exactly where we're at today. That's literally the situation we're in. So historically, what has happened after the same exact situation that we are currently sitting in today? After the major averages have dropped 20% from their peak, the 6-month period following, on average, the markets go up 1.1%. 12 months on average, they go up 8.5. And 18 months later on average, they go up 12.6. So again, the downside of what we have available as losses versus the upside of what we have available as gain going forward, the gain is so much higher. I do not believe that we can afford to hide from the bulls and to potentially miss out on those best trading days that who knows when they're going to come. Nobody has a crystal ball. We can't time those things. So I hope that this helps. I hope this helps to ease a little bit of tension. At least for myself, it always helps to go back and look historically and realize that, hey, this isn't the first time we've been in this situation. It dang sure will not be the last. These things happen. Market cycles are natural. Peaks and troughs are natural. All of these things do take place. It's part of the nature of being invested in the market. But I'm just going to leave you with the fact that patience always does pay off. So with that, guys, that's the wrap up for the June market update. If you have any questions at all, please don't hesitate to reach out. I'm always available to chat. All right, we'll talk to everybody soon. Have a great day.